running your business from home, that portion that you're claiming as a deduction as a work from home expense now makes that property or that portion of the property accessible for a land tax assessment.
Unbelievable.
So people are going...
And capital gains as well.
I didn't get to that too. And capital gains tax as well when you decide to discharge the asset. We haven't even spoken about stamp duty. I mean, that's been around for ages, but you call that, at least in Victoria, roughly 5.5%.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host.
Andrew, Bills, here we are back again and back on the podcast.
Andrew, we are back again and talking national sport today.
Yep, and it's not AFL. Or is that the national sport? Or is that just the Victorian sport?
That's what I was going to say. You need to be careful because it depends on whereabouts in the country you're.
We're in Victoria, right? So national sport for Victorians.
Well, surprisingly, I mean, you know, my national sport is neither of those anyway. It's completely different. So yeah, we'll move on from that one. But no, we're talking about property, and actually
that is the actual national sport.
Well, it's a really fitting time as well too, because on our previous podcast we were talking about decreasing interest rates in a week or so, depending at the time of publishing this episode. It might have already happened, and entering into spring as well, which is traditionally a more active time in the property market. So we are talking about the true cost of owning a property in 2025, because there's probably a lot more to consider these days than there has been in the past, at least in the past little bit anyway. Andrew, let's start unpacking that. What do we think about? What's the true cost of owning property? What's the number one thing that we tend to think about?
Well, number one thing that everyone starts on, and clearly there's more because that's why this is a longer episode than 2 minutes, but most people, when they're considering the cost of a property, usually the first and sometimes only consideration are the repayments. They look at it and they say, my repayments are X, cost of renting is Y, the difference is pretty much the same, so better off buying. And it's not necessarily nearly that simple. But the first thing that people consider is the repayments on a mortgage.
Yeah, the thing that it stands out, I can hear it being said now, I can afford the repayments.
Yeah.
And that's it. That's as far as the conversation goes. And if I can afford the repayments, we're good.
Yeah.
That's it. Case closed, zip, done, full stop, away you go.
Not as simple as that though, right? And even when you are looking at repayments, I mean, the cost of repayments today and the cost of repayments by the time that you expunge your mortgage, it's going to be completely different. I think that's a certainty. And not that we've necessarily seen it happen, at least in recent history, as quickly as what it did. But if the last couple of years have taught us something, it's don't just look at your repayments today. Don't just look at repayments, and factor in a very small buffer. It can move and it can move quickly. And if things change, you want to make sure that there's some buffer room in there.
It's one of those things that we're 2025 now, rewind 5 years, you could borrow $1 million at 2% and you'd be paying 20 grand a year, and it's no big deal, right? In interest anyway. It can move very, very quickly. But the thing that I tend to, when people turn around and say, we can afford it, the thing that I always tend to respond with is, okay, that's great. Can you afford it each and every month for 30 years?
Yeah.
Because it's not like, okay, we just need to take care of it today. What about certain life changes? What about interest rate increases? What about if they change serviceability requirements? What if you lose your job? What if you start a family? All of these things. And in my experience, the older we tend to get, life just gets more expensive and your expenses go up. So life does become more expensive. So you really need to look through that and go, okay, just because the bank says that we can borrow, just because our rent is this and our repayments are that, oh yeah, I only need to factor in the difference. There's so much more that needs to go into it than just that thinking alone.
And this sounds like a really weird thing to say. So I recognize that. But I don't think that people fully appreciate what the difference is. And what I'm saying is the cost of interest rates and a rising interest rate environment was so, and it is so downplayed. Now, that sounds like a really weird thing to say, because anything that everyone's been talking about over the last couple of years, not even the last couple of years, the last 5 years has been the rising cost of living and mortgages and interest rates and all of that stuff. But let's use that example that you were talking about. And, median property prices across a lot of the country sitting in and about close to $1 million. So let's use $1 million balance. And let's consider that someone's got, an interest-only mortgage, just for the simplicity. You talk about, okay, at 2% interest rates, when you're looking at $1 million, 20 grand a year in interest repayments, versus 60 grand a year now at a 6% interest rate, 40 grand a year after tax. Like, you're talking probably close to 65 grand a year in income, additional income that you need in order to cover that difference. And that happened in a really short period of time. So I know that, we're talking about interest rates and mortgages and, everyone's been talking about the cost of living. But I think that when you look at like 2 to 6, you look at just that number from a percentage perspective, and sometimes it's really hard to grasp just how significant that is, because that's not a small shift.
Yeah. I mean, look, let's work through that, because what do you do? And I think some of the things in terms of what do you do, because people have aspirations to purchase property and buy houses and upgrade and so on and so forth. But what do you do? And I guess where we were going with all of this is saying you can't just look at what's directly in front of you. And we're only talking about the interest rate and the cost of servicing the loan. There's still a handful of other stuff that we need to touch on as well. But start thinking about, what does the loan look like down the track, especially if you're, let's make some assumptions, you're younger in life and maybe there's some life changes that are coming down the track and life is going to get more complex and more expensive. So it's not just, okay, what do we do today? But it could be, okay, what's our financial position going to look like in 2 or 3 years' time? And then can we afford the repayments? And the other thing associated with this is the difference between how much we can borrow versus how much we should borrow. Because there's a huge difference between the two. And then lastly is, how much money have you got left over as a safety net, as a security blanket, just in case something goes wrong?
Yeah, absolutely. Absolutely. And I guess once we start looking at some of the other costs, and again, when you are looking at these other costs, it's not static. And this is going to be a lot more difficult to predict. But, we look at, let's say, land tax. And that impact. So I think in the last episode we said that we didn't rip into the Victorian government enough, or we're about to, because I'm just winding Billy up, raring him to go. But you consider, the increase in, what was already an expensive tax that was placed on the Victorian government, or on, investors, particularly in Victoria. And it just got a lot more expensive. And so you look at, the increased threshold and the impact that then has to borrowers when you, start to look at the feasibility of, holding and owning an investment property. But yeah, certainly a cost that is overlooked, and can also be subject to change. And I think that when you are talking about, government charges, generally speaking, it's subject to change upwards. Like, this isn't a declining cost. It's a cost that will only go up. And yes, it's only a cost for 10 years and all of that stuff. While after, all of the hangover from COVID is paid back and it's a COVID tax. Well, yeah, okay, we've all heard that one before. This is here to stay.
So with the government stuff, the unpredictableness of what the government are going to do, and in particular, let's talk about Victoria. This is where we're located. But some of the stuff that we have seen that's come out of the Labor government at the moment is, I'm pausing for dramatic effect here, it's absolutely insane. There is no other way to put it. Coming back to our point that we're trying to make is, you just don't know what they're going to do. And I probably have never felt this lack of confidence in the government. And if you look at what they're doing from a spending perspective, and if you just have a look at how much the Victorian government has spent and has projected to spend over the next couple of years, the numbers are like, we're doing more damage in a decade than we've done in the last 16 decades. Yes, the numbers are phenomenal. When you look at that and then consider and go, okay, how do we pay it back? How do you do that, right? It has to come from somewhere. Property has always been one of those things that they want to put their hands in the pie. So we've seen land tax. That's here to stay. I don't think that's going to go anywhere. The other thing too is if you use your owner-occupier now, I don't know if this hasn't been picked up a lot in the media, but if you run a business from home and you are running your business from your owner-occupier traditionally is exempt from land tax. If you're running a business and you're generating over $30,000 a year in sales, assuming that you're running your business from home, that portion that you're claiming as a deduction as a work from home expense now makes that property or that portion of the property accessible for a land tax assessment.
Unbelievable.
So people are going...
And capital gains as well.
I didn't get to that too. And capital gains tax as well when you decide to discharge the asset. We haven't even spoken about stamp duty. I mean, that's been around for ages, but you call that, at least in Victoria, roughly 5.5%, depending on what that lower threshold looks like at the time. But they're just taking their chunk, or they're taking their cake and eat it too, essentially. That's what's happening.
And on stamp duty as well, and, tying it all together in regards to government charges, but then also changes and how quickly that can shift. I don't know how much truth there is, but there's already been some leaked reports as to what the Labor government is proposing. And they're proposing some changes to land tax and stamp duty. And one of the things that they're talking about is adding, like a 1% annual tax on property as opposed to stamp duty. Now, really basic maths here, but you consider that most people will own a property for longer than 5 years. Cost of stamp duty is, let's say 5.5%. If you're paying 1% every single year versus an initial once-off 5% and then that's it, unless you're holding a property for less than 5 years, again, you do the maths and it's more tax that you're going to end up paying.
So rather than paying the stamp duty once when the property is transacted on, what this will do over a period of time is
if this is true and all of that stuff, but there's been talk about this for a long time.
Commercial's already there, but it will convert a once-off fee, essentially duty. It'll convert it to a yearly payment for every property over time once they get transacted on, and it falls into that mix. Yeah, so you own a house, but you continue to pay.
Yeah. It's really funny because
that doesn't work in that kind of sense. It's all right. Can I get that?
Well, normally, if you're, sharing the benefit of owning something, then you generally share the cost. Doesn't feel like that, does it?
Yeah, if they want to help me pay my mortgage, then maybe they can take their pound of flesh, right? But no, you're absolutely right. Yeah. I'm really worried about what the Victorian government are doing just in terms of their fiscal management. They don't know what they're doing. Completely out of control, spending money absolutely recklessly. And some of the stuff coming out of Jacinta Allen's office just makes no sense and is not grounded in reality. Talking about mandating, and I know that this is not property related, but just to go and show the lunacy that these guys are doing, talking about mandating mandate stay-at-home days, work from home, that's the word I'm thinking of, 2 days a week for the public and the private sector. So basically enshrining that in law and saying you're working from home 2 days a week out of the 5.
How does
that just blows my mind. How does that even work?
I mean, if a private business says this is our policy and this is what we're going to do and we're going to offer this as a benefit to our employees like, we do here at 360, fine. But to legislate that and mandate it for businesses is absolutely bonkers. And to think that, how do you determine what jobs can and can't be done like that? There is a relatively large portion of jobs that physically cannot be done from home, and mandating 2 days a week from home, lunacy. But not what we're talking about here. So we'll bring this train back on track.
Moving on to the next one. This is a really interesting one because I swear when we bought our place in 2018, I said to Samantha, this is perfect. It was turnkey, right? Didn't need to lift a finger. You know, I haven't stopped since, and I reckon I've run one sort of semi-major project every year. They're not major projects, but doing something every year. This is
finance.
This is maintenance and renovation costs.
Yeah.
So even though, you know, you may get something to a certain level, it still needs work to maintain it.
Yeah.
In our instance, there was stuff that we did to sort of improve it in bits and pieces, but you can't downplay that because that can get quite expensive depending on what it is, and the cost of absolutely everything. You know, getting tradespeople in, building material, bits and pieces is expensive.
Yeah, and it's gotten more expensive. So even if you're talking about maintaining the quality and the integrity of a home, you need to spend money on it in order just to maintain that. So you have to factor that into your budget when you are looking at, you know, owning a property versus renting, because, you know, when you're renting, that cost is borne by the owner.
Yeah, and then with an investment property as well too, some of the compliance costs associated with it.
Back onto the Victorian government.
Gas checks, electricity checks, whole range of different stuff that's needed to happen. And some of those were positive, don't get me wrong. You know, you had landlords, they called them slumlords and stuff, where they'd organise another bedroom on the balcony and stupid stuff like that. So we did need an increase to the standards. Has it gone too far? Has it overreached? I'm not sure. We're probably not here to debate that. But what it does do is it increased the cost of owning properties. Sorry, just on that, we were talking before about government charges. If you think about something like an Airbnb, so the government have also mandated, depending on what suburb and location that you're in, how long you can and this is the local council, so the local government, not the state government. So I've got to get that clear. But how long of the year you can offer that property on Airbnb. So you're not, you know, depending on where it falls, it's not like you can rent this thing out or have it available for 365 days of the year. It's quite limited and could be quite stringent in terms of what that does look like. So once again, you know, thinking about it from a cost perspective, but also from a government control point of view, it's not good.
Yeah, exactly. Strata and body corporate fees. I mean, look, that's, you know, one thing that most people will consider when you are looking at a property that will have body corporate fees. I guess one of the things to consider with it is, again, body corporate fees are never fixed, and so if there are, you know, rising insurance premiums, if there are things that need to happen on the property, an absence of a sinking fund in a strata or a body corporate can leave you exposed, because it's essentially like, you know, running your own personal budget without a rainy day funds. If something needs to happen, especially if something is relatively urgent, it will happen regardless, and all of the owners will get a bill for it, and it's a figure it out.
Yeah, sinking funds are quite interesting as well too. I mean, if you consider that maybe there's some planned works, we need to get the roof replaced and we need to do that, and the estimated cost is $100,000. So over the years, every, you know, different property is chipping in, what have you. If you expunge a lot or most of that sinking fund, if I was the person running the body corporate, I'd be like, okay, the kitty's now empty, we need to top it up. So we might take a bit from the sinking fund, but we might actually impose a charge as well too on people. And you've got no, you know, you might be able to go to the meetings and what have you, but you don't really have any say or control over this.
Yeah.
And it can be quite hefty, and especially when you get into a building that has additional amenities. So when you start to talk, there's sort of two things that spring to mind for me, at least immediately. Elevators is definitely one, because the cost of servicing and maintaining elevators is quite expensive. And the other thing is, because they go wrong all of the time, is swimming pools. Yeah. So if something goes wrong, if you've got a building that has those, and the body corporate says, you know, we need money to fix it or maintain it, you don't have a choice.
Yeah, exactly right. And so I guess one of the things to consider is that if you kind of need to adjust your personal budget based on your circumstances and say, okay, our building doesn't have a sinking fund, let's say, and we know that there are going to be repairs and maintenance. So what are the things that you can do about it? I mean, one is trying to influence to potentially bring that in, is one of the considerations, but, you know, your ability to influence that is not necessarily that high or may not even be possible, but it means that your emergency fund buffer needs to be larger. So you've got to factor that into your own overall equation.
And your insurance costs.
Yeah. Insurance costs are rising.
Yeah.
Across everything. I mean, you talk about insurance costs in, flood risk areas because of some of the natural disasters that have happened recently. But also when you're talking about, home burglaries and the cost of, your contents insurance, the cost of your building insurance, all of that stuff has been rising, as with, the cost of everything rising. And so, again, insurance premiums are another thing that you need to consider when you're factoring into a property purchase.
Yeah, and those ones they're so difficult. Like when I put together my personal budget, even the business budgets and stuff like that as well too, you might look at an expense from the previous year and go, okay, I'm going to add 3% or whatever it is. Insurance is that one that you can't land on it because it like goes into this black box and they just, they muck around with some stuff and out pops something and that's it. And there's nothing that sits behind it where it says, okay, this is what we're like. How do you do it? So you need to add significant numbers to it. It gets harder and harder, and the more it compounds the issue as things go wrong around the world as well too, or in your country as well.
Yeah.
The car insurance one, just digressing for a sec, I love this one, right? So every year, my car insurance renewal comes in, and I pick up the phone and ring them and shit stir them. So, okay, the car's gotten a year's time on it. No, seriously. Answer me this, because they can never answer it. The car's a year older.
Yeah.
So it's less valuable. I've got a year's more driving experience. Yeah. So why is my premium going up? And they can't answer me.
I could answer you.
No, you can't. Not with any sense of accuracy.
I'll answer you with 100% sense of accuracy.
In reality.
Okay, do you want me to explain to you why publicly on the podcast?
You're going to wreck my story.
Really, your car insurance premium goes up every year because every year you're more and more senile. You're more and more of a senior. And given that you're in that age bracket where, your car license should be taken away from you.
Yeah, okay, I get it.
You're becoming riskier. That's why.
You know what? Maybe if you told me that, I'd be satisfied with the answer, but they're not telling me that. Definitely.
Just another opportunity to rip into Billy's age.
That's it. Andrew, hidden costs off the plan.
Yeah.
Yeah, those ones can be really nasty.
Yeah. I mean, look, there's variations. There's rising in construction costs. There's, what we've had in the past with, risk of a developer collapsing and, left with a half built building and who's going to cover the, insurance if something goes wrong. I mean, there's all of that stuff, but then there's even the cost of, okay, we expect the property to settle by X date. Mm-hmm. And so, all of a sudden we've got a lease that's ending at this date, or we've sold our existing property that's going to move out, by this date. And all of a sudden there's, delays. And it's not necessarily a cost initially, but it is a cost because what do? I mean, you need to either try and renegotiate things. Alternatively, you're moving stuff into storage and you're renting for a period of time. You're living in a, serviced apartment, because there's any number of things that can happen. And when you are talking about new buildings off the plan, or even just a, construction on, a block of land that you're doing on your own, there are some costs that you need to factor in as an emergency buffer.
Yeah, that one there. And I've heard some real horror stories, and the worst one that I've heard, and it scares me, right? You put down a deposit, and in a construction loan, you pay in stages, right? So usually after the deposit, the next stage is the concrete pour. Concrete got poured for a client. I actually think this might have been one of your stories, Andrew. I'm just going to steal it as one.
Yeah, take it as your own.
It's one of the practices ones, right?
Yeah.
So if I do butcher it, you can come in.
No, that's all right. I'll leave you to it.
Basically,
I've already ripped you once. This
concrete got poured. Builder went broke. Next builder that came in couldn't guarantee the work of the concrete, like that the foundation was done properly. So they're not going to necessarily erect a property on that concrete slab because they don't know what's underneath. And then this client was basically left in limbo, and I don't even know where it progressed to, but was that the crux of the story?
That was the crux of the story, yeah. It was basically choose your poison. You're either going to have no insurance, so the standard 7-year insurance on a construction, where a builder said, no, we're either not, giving you that tick of approval or giving you that protection there because we don't know what's underneath.
Or rip it up.
And, we're going to obviously charge you more to rip it up and re-pour it again.
What did they do?
They ended up saying, oh, well, concrete's poured. So
you got it just on top of it.
Yeah, we're not ripping it up. Yeah.
I don't even know what that cost. Yeah.
I would hate to even imagine it.
Yep. Okay, there we go. Andrew, the cost of, the opportunity cost, I should say, of tying up equity.
Yeah. I mean, look, when you are looking at a property, you do need to consider it's not just the absolute value. So it's, okay, this is maybe what I've made from that property, but what's the opportunity cost of what else I could have done? Had that money not being tied up in that property and was tied up elsewhere, would I have earned more money by investing it in, let's say, the share market? Or even, am I, as a result of this property, am I asset rich but cash flow poor? Really standard equation when you're talking about investment properties, particularly when, or prior to the rise in rental yields that happened more recently. But looking at the opportunity cost of what you've missed is also a hidden cost that most people don't even consider.
Yeah, interestingly enough, while you were doing that, I just ran a calculation. So in a mortgage calculator, I've put in, you borrow $1 million over 30 years at 5.5%. Keeping that consistent, assuming that everything else stays the same, not only are you paying back the $1 million that you've borrowed, you're also paying $1,044,000 in interest. So you borrow $1 million, it costs you $2 million.
Yeah.
So you think about opportunity cost and tying up capital, you've spent an additional $1 million. So you're going to want to hope that you get that back from a capital growth perspective over those 30 years.
Yeah. And look, I'll use another horrible example, but similar vein to that, which is client had purchased a property. It was an investment property. It was purchased 10 years ago. And that property has not moved in value. So did not make a good decision as to the type of property and the quality of the asset. It was, off the plan on a main road, apartment. Anyway. And so they're now looking at it and saying, okay, stamp duty, yep, everyone tends to remember that one, but we've lost the money in relation to the stamp duty and the cost of the property purchase. And okay, we might make a capital loss of, maybe $20,000 or $30,000 by the end of it after we take into account some agent fees and all of that stuff if it sells for the same price. But what most people tend to not consider in this scenario is if that property doesn't move in value, one, there's the interest that you've paid for it. But two is inflation and any other asset that you could have invested in has grown over that period of time. Whether it was invested in an alternative property that performed better, whether it was invested in the share market, whether it was, regardless of where those funds could have been invested, it's one of those things of the opportunity cost of, okay, well, it was in a stagnant asset. What else could it have been doing, and where would it be if it wasn't for that decision?
It's interesting when you tend to think about that and you go, yeah, it's such a scary thought. And we're talking big numbers here. $1 million, the property doesn't grow the way that it meant to. If I, put that money somewhere else. The other thing too, taking into consideration is the time it takes to save the deposit to get into the initial property.
Yeah.
So yeah, you're talking about, it's interesting. You want to make sure that you know what you're doing.
It just highlights that whenever you're making a decision, debt is going to magnify your gains, but it'll also magnify losses. And so, if you are making that decision, you need to make sure that you're selecting the right asset and that you're doing it with some thought.
100%. And probably just some final things, some of those other hidden expenses that we don't tend to think about, conveyancing costs, moving costs, the cost associated with moving into a place. Even if in my experience, even if you move in, there's always something that you need to do. Whether not that necessarily that maintenance piece, but we've got an extra bedroom or an extra living area. I don't have furniture to put in there. I need to get some more furniture. Yeah. So there's always these little bits and pieces as well too that you need to think of. That's quite easy to overlook.
Yeah. I do want to end this note on a bit of a positive run. No. We're going to finish on a positive, Bills. We're finishing on a high, because I mean, you look at all of this and it's like, well, why the hell would I ever invest in property, or why the hell would I ever buy a property? And I think that it's an important thing to note that absolutely in no world are Billy and I saying not to purchase property. It's one of those things that I don't think, particularly when you're talking about Australia, I don't think that there's been a better accelerant to wealth accumulation. Maybe the share market, but it's not participated in as much by regular mum and dad investors. But you consider the wealth that you can create with a small amount of money in property is absolutely insane. I think that what that's done in the past has maybe bred some complacency. And I think that it's just as important as any other asset class to make sure that you're getting good advice, make sure that you're not overextending yourself, make sure that you're buying the right type of asset, make sure that all of the things are ticked off, because it still can be, and it still is, a fantastic accelerator for growth. But there are costs and there are things that many people don't think about and don't consider, because the market itself has been, in essence, a victim of its don't.
Yep. And look, just to add my little 2 cents worth, Andrew, agree with what you've said there. Having a roof over your head, albeit mortgage, so the bank owns it, but having a roof over your head, especially what we're seeing of late with the tightness in the property market and what that means and how quickly rents have increased over the last couple of years and stuff, the amount of security that it gives you, it's really hard to define in monetary terms. And I can't even, describe what that is, but it gives you this sense of security. I can only imagine what it's like once I pay off my mortgage and start paying land tax every year instead. But you get my point, right? So yeah,
I think
in terms of what it gives you is phenomenal.
And one thing that I've seen, I agree. Because I mean, one of the things that I've seen, and I'm actually going through with a client at the moment, is rent vesting fatigue. Whereby they've went down the route of rent vesting because the numbers made sense, and they've had to move because the owner's been selling and they haven't been happy with a particular property. But yeah, anyway.
It's an interesting thought when you're younger.
Yeah.
What's it going to look like down the track? Because you're going to want to rent vest, and like moving. I don't even want to clean my garage at home, and it's going to take me 20 minutes. But moving is a pain in the neck.
Yeah.
Imagine doing that when you're older. And older, it becomes more and more of a headache. So yeah, that's a really interesting one.
Yeah.
Andrew?
I think we went a bit over what we normally do on that one, but there was a lot to uncover and a lot to talk about. So Bills, thanks for packing in a whole heap of value for our listeners and our viewers. Thanks to everyone for tuning in. If you got some value out of that, like, subscribe, and please reach out if you've got any questions to either Billy or myself.
Details are in the show notes, and we'll catch you on the next one.
Thank you.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.